what do founders hire VCs for? What is the most important thing that you pay for when you hire a venture capitalist? And Mark Andreessen had an AMA a year or two ago where he had a great answer, where he said, I have always thought that the thing that founders are hiring venture like VCs for is borrowed credibility. Like, hey, let's say you were an engineer at Databricks for a couple of years and now you're leaving and you're starting a company. It's like, well, who are you? Like maybe you have a little bit of like brand rub off from Databricks, but by going and raising from a venture firm that other people respect. So like the venture capital firm has built this like respect, whether it's through the other companies they're associated with, the other things they've done, whatever. Then it's like I as a hire, it's de-risked for me, right? Or I as a partner, or I as a customer feel like that's de-risked. The other argument comes from Vinod Khosla, where he says the vast majority of VCs provide zero value, and an unfortunate portion of VCs drive negative value. Like it's actually worse to have them along for the ride.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to the Run the Numbers podcast. Today, I have my friend Kyle Harrison on, general partner at Contrary Capital, one of the sharpest minds thinking and writing on Substack about the evolving game of venture capital. Check out Investing 101. Kyle's explaining the madness to us, like why fund size isn't just a number, it's a strategy, or why some firms are playing for yield instead of upside, and why that changes the game not just for VCs, but for the founders they back. In this episode, we get into it. We talk about how the biggest funds are warping incentives across the board, how misaligned fund size can sabotage great outcomes, and why the most dangerous trap for founders isn't dilution, it's optionality. We also dig into the psychology of missed bets. Is it worse to back a loser or to miss the next Figma? Kyle shares his take on venture's original sins and why outcomes are still bigger than we can imagine, and how upside can mask some truly wild risks. And then we zoom out. What will we laugh about in 20 years? What will we wish we paid more attention to? Plus, a few spicy chess moves from firms playing a different M&A game entirely. All this and much, much more after a short word from our sponsors. Most finance leaders still see travel as a cost center, something to manage, reduce, or delay until the numbers look better. But the Navan Business Travel Index, validated by NASDAQ, empowered by millions of corporate transactions captured through Navan's platform on how organizations are meeting and investing in face-to-face connections to fuel growth, tells a different story. Companies that are growing are moving. Business travel activity is up double digits year over year. International hotel spend is rising faster than domestic. Rideshare use is surging as teams compress more high-value meetings into fewer days. This isn't about perks. It's about pipeline, deal velocity, and customer retention. The CFOs winning right now aren't slashing travel, they're optimizing it. They know exactly where every dollar is going and the ROI it's delivering. The Navan BTI helps you see how your program stacks up against the market each quarter and where you might be leaving revenue on the table. Get the data. Spot the gaps. Turn your travel spend into a competitive edge. Download the latest Navan Business Travel Index today at navan.com/BTI. That's navan.com/BTI. And lead with the numbers that actually drive growth. Morgan Stanley recently said NetSuite is under the threat of disruption. That's right, NetSuite, the you never get fired for buying it software. So what's the threat? The answer, Rillet. Rillet is the AI native ERP modern finance teams are switching to because it's faster, simpler, and 100% built for how teams operate today. It doesn't take 12 months to implement, it doesn't feel like filing taxes to use, and your accounting team will actually love it. PostScript closes the books in only 3 days. Windsurf, bet you heard of them, they run finance with just 2 people. And Rillet is backed by Sequoia Capital. Yes, that's Sequoia. Unicorns like PostScript and Windsurf and hundreds of other companies have made the switch, and they're closing books in record time. If I were running a finance team today, I wouldn't default to legacy. I'd look at what's coming next, and Rillet is here. You don't want to be that guy at cocktail parties complaining about how bad his ERP is. Wait, am I the only guy who talks about ERPs around a keg? See how fast your team can move. Book a demo at rillet.com/metrics. That's RILLET.com/metrics. RILLET.com/metrics. As a CFO, you're expected to bring clarity to everything, including how your company manages ownership. The tools you use should make that easier, not harder. But when they come with hidden fees, data you can't always trust, and support you can't rely on, you end up with more frustration than clarity. That's where Pulley comes in. Pulley is the cap table management platform built for finance leaders who need accurate, decision-ready data from a system that works for your business, not against it. With Pulley, you get intuitive workflows, audit-ready reporting, and support you can count on, all backed by predictable pricing you can plan around, so you can stay compliant and make smarter decisions about your company's future. Manage everything from fundraise modeling to ASC 718 reporting to custom liquidity programs, all on one trusted platform. Hundreds of high-growth companies like Linear, Fathom, and Runway trust Pulley to help turn ownership into a strategic advantage, and joining them is now easier than ever. You can switch to Pulley in as little as 5 days, and for a limited time, they're offering 25% off your first year. To claim your exclusive offer, visit pulley.com/mostlymetrics. That is pulley.com/mostlymetrics. Pulley.com/mostlymetrics. Kyle, man, I feel like this has been a long time coming. Thanks for joining the pod.
I'm excited to jam, man. You're a kindred spirit, so I'm sure we'll enjoy the conversation.
Well, there's no greater fan of your writing out there than me. You were actually one of the reasons that I started on Substack, because I've been reading your pieces for a while. You found product market fit or audience market fit before I did, though.
Well, I don't know about that, man. You have far eclipsed me in your ability to grow a publication. So I'm honored that you would even mention that, because you are a true you've built a true empire.
Well, that's the benefit of now making this my full-time job. I mean, you're investing, you've had a ton of success before coming to Contrary, and then I feel like you're building this fiefdom. And so, like, I want to pick your brain on the trends that we're seeing within venture capital, and then I'm also going to reference a couple of the pieces that you've written along the way. Does that sound okay?
That sounds great, man. Excited to jam on whatever.
So from the top, I got to ask the people, are you a little bit grumpy that these big funds are coming in and messing everything up for the cottage keepers here?
You know what? It's funny that I feel like when I jam with people about the stuff I've written about, I often find that there are people that are like, man, these agglomerators, like, such a fascinating business model. Like, it's so compelling, like whatever, they love it. And then I meet other people that are just like, this is disgusting, and it's such a bastardization of everything that's pure and good about venture capital or whatever. And it's like, I have experienced people who are not only on two dramatically different extremes, but also who assume that I am on their extreme. Like, either I'm on this extreme or on that extreme. And I take that as a compliment that I think I've done a pretty good job, where, like, I have just stated the reality of the situation and tried really hard not to, like, pass judgment on, this is what bad venture capital looks like, this is what good venture capital looks like. I frequently will pass judgment on what I think is bad behavior, right? Like, there's plenty of, like, hucksters and charlatans that I'm happy to trash and talk negatively about. But when it comes to, like, the fundamental business models of venture capital, I go back to a piece that I wrote where I talked about just playing different, stupider games. And the stupider game is not, oh, this model is the stupider game, or, oh, this model is the stupider game. The stupider game to play, the stupidest game to play is playing a game, not realizing that somebody else is playing a fundamentally different game that disadvantages you. And so I like agglomerators. I like cottage keepers. Everybody teach their own, can do interesting things. The only thing you have to appreciate is that they're playing different. They're playing, like, dramatically different games, and everybody needs to adjust their strategy accordingly.
Because you've described the VC world as divided into these cottage keepers and capital agglomerators. In, like, plain terms, can you just maybe describe what that encapsulates, and maybe you can reference a couple of examples of firms that are out there that people can, like, lock their heads to?
The clearest illustration of these two dynamics is if you take a step back and look outside in, because the internal marketing of how the firm talks about itself is going to be very similar. Like, every venture capitalist talks about themselves as very founder friendly, just a champion of the underdog startup founder, whatever. Like, I've always said that the marketing of venture capital and the business model of venture capital are very different. So don't get distracted by the marketing, how people talk about themselves. If you take a step back out and you look at different firms, you can clearly see that there is, at least inherent in the model, whether or not deliberately internally, there is an optimization for a very different number. And the number that capital agglomerators are optimizing for is AUM, and effectively, you boil that down to a business model, fees, right? Because every venture firm, on average, makes 2% of their AUM in fees every year, and then the 20% of the upside of the carry, how much money you make your investors. And so when you're growing massive AUM firms, these are 50, 60, $70 billion AUM venture capital firms. The fee on that is going to be massive. I mean, you're making hundreds of millions of dollars a year on fees. Then you have other firms that keep their funds fairly, not necessarily small, but like very balanced. And it's usually like less than 200 or 300 million of capital per fund. And it's clear that what they're optimizing for is that they have the ability to drive 10x returns. So you might have a $200 million fund. You can turn that into, $2 billion or whatever. When you have $7 billion of funds, it's very difficult to turn that into $70 billion of value. And so capital agglomerators are generally focused on sort of like, hey, like we can have, call it 1.5x, 2x-ish returns, like funds. Whereas cottage keepers are keeping their funds very small deliberately so that they are able to turn that into a 7, 8, 10x plus fund. It's just very different models.
And there is this inherent, I guess, pull towards just like taking on as much money as possible. But like to play back what I'm hearing, it is harder to find enough great investments to park that capital into.
Yeah. I mean, like the pull of a bigger fund is that there's a Steve Schwartzman quote, the founder of Blackstone, where he says, it is just as hard to build a small business as it is to build a big business. So why not build a big business? Which is totally fair. Like that, there is some validity to that. I think that there is a breakaway point where at some point when you break into building a business of a certain size, just the weight of financial gravity becomes a difficult obstacle. And the weight of gravity here in terms of like building a bigger and bigger venture firm is your point of there are only so many companies that can be truly generational companies to generate these massive, massive returns. And like, it's like you look at even taking into account some of these incredible businesses, just like the sheer volume of market cap, because it's like if you want to generate, call it a 3x fund on a $5 billion, I've done the math in a couple of my pieces, but it's like to think about like, okay, we need to turn $5 billion into, a 3x fund, so $15 billion of value, right? Of that $5 billion, it's still the power law holds even in larger funds. So there's probably 80 to 90% of that is going to go to zero. A chunk of that is going to return kind of a small thing. So you do the math. It's like you're going to need a handful of companies to generate dramatically more in market cap and in end value to be able to justify your losses and still generate that $15 billion or whatever of outcome. And so it's like the number of companies that can do that is just like very, very small. And that's why one of my pieces that I wrote is the unholy trinity of venture capital, where you have these like yield farmer LPs who they're not looking for 10x returns. They need like 4 or 5% IRR yield. Then they pour that money into capital agglomerators who are just racking up massive funds and are just trying to be everywhere and everything and be massive and take up all the oxygen in the room. And then you have these hungry hippos, capital absorbers of these companies like OpenAI, Anthropic, companies that want to raise tens of billions of dollars. Those three are a match made in heaven because they're perfect at throwing huge amounts of capital and being able, you see this with like the Anthropic CEO talked about like a couple of years ago. He said, oh, we'll never take like Saudi money. Like we're never going to go looking for these like big, massive kind of ethically questionable sources of capital. And then recently he said like, well, listen, we it's expensive to build these safe systems. We got to go. And so now they're taking Saudi money. And it's like, yeah, of course they are, because that is the triumvirate that you've built for yourself to be able to pour massive capital at these things.
The hungry hippo analogy, like that totally hits, because it is a marriage made in heaven when you're able to take on so much capital. What comes to mind is when A16Z invested in Adam Neumann's new startup, because it was kind of like, where can I park? Like, I think it was like 300 million, or I may be getting the number wrong.
Yeah, it's 350 million. It was our largest ever single check.
And you think about like, okay, we hope we can 3x this, 5x this. I mean, they probably want to do more than 3x on their type of funds, but like the management fee on that alone is huge.
Well, and actually, again, I have no inside knowledge of how Andreessen thinks about their funds or markets or whatever, but my sense is that they don't, maybe just for like plain, vanilla math or whatever, they benchmark to that 3x. But like, they're definitely not thinking about 5x. And candidly, I think even if their funds return, 1.5, maybe 2x, generally, I think their LPs are fine with that because they don't need, like, if you're an LP and you're parking $200 million a pop into these funds, you don't need that to generate 10x, right? That's why I call them yield farmers, those types of LPs. They just need a little bit of yield on that money. They just need that money to be working, because when you're CalPERS or whatever, you're managing, $100+ billion or whatever, it's like, you don't need 10x's, you need 4 or 5% yield type things. But like the Newman example is perfect, because what a lot of people said when that first happened is people were like, well, you can't deny that like he's built a big business. And it's like, right, maybe, but you can also not deny that he built a bad business. Like he built not a good business. But like the thing that he is good at, it is totally true, is like raising a ton of capital and telling a massive story and being able to chase a huge vision that will justify pouring, hundreds of millions of dollars, if not billions of dollars, into that story. And then from Andreessen's perspective, it's like, listen, most stuff fails. So it's like, yeah, things will fail. But if this works, we can't afford not to be in the thing that becomes this massive thing. It's also one of the reasons why a lot of these firms have started investing in competitors, is because they're like, listen, we don't really care anymore about the dynamic of like founder friendliness. We just have to be in the winner. Because if we're not in the winner, we cannot justify the volume of capital that we're deploying.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Well, if you've listened to this podcast before, you definitely know that I think it's cool to be a fan of business. I'm obsessed with researching how the best companies operate, and specifically how they manage their money. And I've learned that a company's financial stack can make the difference between world domination and obscurity. That's why I want to tell you about Brex, because I want you to rule the world. Brex is an impressive financial services and software company that has grown immensely since it was founded in 2017. In just the last year alone, Brex accelerated customer acquisition by 50%, with 91% growth in enterprise customers. And there's good reason that over 30,000 companies from startups to enterprises have flocked to Brex. Brex offers the world's smartest corporate card on a full stack global platform that is everything CFOs need to manage their finances on an elite level. Plus, they offer modern banking and treasury, as well as intuitive expenses and accounting automation, bill pay, and travel. Wow, it's all in the roster whenever you need it. Brex grows with you. CFOs tell me all the time that Brex makes it easy to control spend before it happens, automate annoying tasks, and optimize their finances. Because listen, at the end of the day, Brex helps them make every dollar count. So if you're a fan of smart businesses too, check out Brex at brex.com/metrics. That's brex.com/metrics. So if you listen to this podcast, you'll know that I am incredibly passionate about the FP&A space, because that's the route I went to get to CFO. And I want to tell you about a tool that has exploded over the past few years. It's called Aleph. And I remember getting outbounded by them about 2.5 years ago, and I actually took the bait because they claimed to be able to do a demo with my live data, with me right there on the call. And so I had to see it to believe it. And it was the founder running demos back then. Shout out Albert, hope you're listening. And he connected my NetSuite and built my P&L using their Excel add-in in like 15 minutes. And I was really impressed. Since then, Aleph has gone on to raise money from some of the top VCs out there, and they've built an impressive roster of customers. Many of their customers have been on the podcast, like the CFO at Turo, 8 Sleep, and Zapier. They're all really big champions and supporters of Aleph like me. But it's not just an Excel add-in. Aleph also allows finance teams to work with their live cross-system data using Google Sheets and their web app. And that's cool because it gives teams the option to support a wide range of needs and workflows like budgeting, forecasting, and variance analysis. And speaking of variance analysis, they're doing some really cool things with AI-powered variance analysis. It basically allows you to figure out what's going on and why, and it takes the time that you'd usually spend from hours to minutes. It's really cool. So I highly recommend checking them out and taking them up on that demo or trial, just like I did back in the day. And you can learn more and get started at getaleph.com/run. That is getaleph.com, aleph.com/run. Tell them CJ sent you. All right, I got to get up on my soapbox for a sec here. Everybody's talking about AI-powered this and automated that. But here's the thing about revenue recognition. It's not just about moving data around. It's about getting it right, full stop. So RightRev is laser focused on one thing, RevRec that auditors actually trust. See, there's a difference between automating revenue processes and automating revenue recognition correctly. RightRev was actually built by the godfather of RevRec, who understands ASC 606 compliance, audit controls, data validation, and the flexibility needed for complex B2B contracts. We're not trying to be your billing system or your ERP. We're the revenue recognition engine that sits between your contracts and your financials, making sure every dollar is recognized correctly, on time, every time. Companies like Snowflake and Logic Monitor don't just need fast revenue reporting, they need revenue reporting that's audit ready from day one. And that's honestly where RightRev shines. And what I love about RightRev is they're not out there trying to be everything to everyone and just slap some, AI slop on top of it. While everyone is building these massive platforms that do everything in a kind of mediocre fashion, RightRev does one thing exceptionally well. They make sure your revenue recognition is bulletproof. Ready to stop gambling with your RevRec? Visit RightRev.com to see how we make complex revenue simple. That's RightRev.com, where revenue recognition actually works. Wait, so we got to touch on that. I wasn't even planning on asking you about that, but I was listening to a podcast the other day. I think it was 20 Minute VC, and Jason Lemkin was touching on like the idea that basically when you back a founder in one space, you can't back their competitors because like people will they have like a visceral reaction. Like, you believed in me and now you're doubling down on somebody else who's my direct competitor. Like, it's antithetical to like the blood, sweat, and tears that I'm putting in here. And a lot of these funds say like, oh, we are founder friendly. But it sounds like a lot of that's going out the window, and they're prioritizing like this is a can't miss, because like my downside is I lose 1x, but what happens if I miss out with like an OpenAI or Anthropic and my upside was 100x?
100%. So I wrote a piece a couple months ago called "The Horse, the Jockey, or the Whole Race," and it was basically based on a conversation that I had with Eric Newcomer about a tweet that I had tweeted, where there's this anonymous account that is amazing. If you're not following him, you should follow him. Endowment Eddie. He's awesome. And he tweeted and basically said like, okay, wait, so is investing in competitors like on the table now for VCs? And I posted a picture that I like very roughly made super quickly. But it's like Andreessen is invested in OpenAI, Thinking Machines, which is one of their former co-founders' new company, Thinking Machines, XAI, Mistral AI, and Safe Superintelligence. And so it's like there's 5 companies right there that are basically all largely competing, chasing the same thing. A number of companies that are invested in OpenAI and Anthropic, XAI and Anthropic and OpenAI. Like it's very incestuous when you have the largest firms and the largest AI companies. It's super incestuous. If you looked at the same chart, the like Uber versus Lyft battle years ago, there was actually a lot of like overlap where like there was sort of some obfuscation and people would try to invest in things and then later invest in other stuff and whatever, or they had invested in other non-Uber versus Lyft, but like Zipcar or whatever, and then invested in Uber because it became the winner. That was like a baby version. AI is like that times 10 on steroids. Like it's insane. And the reason for that, when you look at most of these firms, and there are definitely exceptions to that. There's a few firms, folks like Thrive and I think Founders Fund, who have been monogamous. So there are a few firms that have like a few big firms that have kind of committed to that. Hey, we're going to invest in one company. But if I'm Andreessen, it's like, well, why would I invest in multiple companies that are largely chasing the same thing? And the reason for that is because it no longer matters this like founder friendliness. Andreessen has so much capital, so much power, so much halo effect. It has become this black hole of influence that you can't ignore Andreessen. Even if you don't like them and they make you grumpy, like it's really hard to ignore them because they're so powerful. And so because of that, they are able to go invest in multiple companies that are largely chasing the same thing. And maybe they justify it because they say, oh, like OpenAI is really focused on consumer AI applications and Thinking Machines is more focused on these like, I don't know, like, or like Safe Superintelligence is focused on a very specific kind of like model development or whatever, like, you know, who knows? Whatever the justification is, like it's lip service, right? It's like these are all companies who are largely chasing super intelligence, whatever that means. They're doing it through, we need to build the highest quality models and deploy them in the use cases that will get the highest volume usage. And by doing that, we will get the volume of data and the volume of feedback and the ability to learn. They're all chasing the same thing. And if you're Andreessen or, you know, Sequoia or Lightspeed or whoever that are investing in multiple companies, your thesis is, listen, we have to deploy $2 billion or whatever our latest fund is. In order to justify the existence of a $2 billion fund, if OpenAI becomes the one breakout, and it already is like whatever $200 billion outcome, but if it becomes the like $1 trillion outcome, you cannot miss that winner. If you're deploying $2 billion, that means like you have to be in the winners.
What blows my mind about that though is like how much times have changed. Because 5 years ago, Kyle, if I said like a fund, they're probably gonna make between 14 and 15 investments in this fund, and they're investing in both Brex and Ramp, I'd be like, isn't concentration supposed to be a feature, not a bug?
The biggest problem these days is just the volume of capital. Like, I don't know the specific numbers, but like if you go back and look at like the volume of dollars going into venture capital, and a lot of people talk about like, oh, it's like a fundraising winter. Like it's really difficult for funds to raise capital. That's true, but it's not because capital is not being raised. It's because on average, most venture firms are having a hard time raising. But like the top 5 or whatever are raising like 70, 80% of any of the capital raised in a particular quarter. So it's the exacerbation of the power law and like the hollowing out of the middle. And that's true in companies, that's true in funds, that's true in all these different cases where like it's really difficult to build a middle ground company where you're just like a nice sort of, big, but not too big, whatever business. It's hard to build a venture firm where like you're big, but not too big. Because once you raise $1 billion as a venture firm, in order to deploy that capital, when there's so few companies that are truly like generational businesses, you have to be competing with people that have $5 billion funds. And in order to compete with a $5 billion fund, you feel like, hey, $1 billion's not enough. We need to be able to take a big swing and write, a $200 million check really comfortably. And it's like, oh, at $1 billion, that's 20% of our fund. That's uncomfortable. But if we had a $3 billion fund, that wouldn't be as uncomfortable. So we could take big swings. So you start to get yourself pulled into, I have to compete with these bigger firms. So it's really difficult across the board for anybody to exist in the middle ground.
And you've said before that your fund size is your strategy. Kyle, can you give an example of when that disconnect between fund and founder became a problem?
Yeah, I mean, I think that is probably, if I had to articulate like the number one thing that drives me to write the stuff that I write, it is because the volume of conversations that I have with founders who lack a fundamental understanding of how venture capital works as an industry, that scares me. Like these are people who are making very big decisions that have implications for their entire, life of their business and potentially the majority of their career. And they're not taking into account the underlying psychology and economics that these venture firms are being driven by. And like no fault of their own, right? Like venture is a pretty opaque, difficult industry, and it has changed dramatically, to your point, even just in the last 5 or 6 years. So I'm not surprised that they don't understand it, but it scares me that they lack that understanding. And so I try and pull back the sort of sheet and be able to expose how a lot of this psychology works and stuff like that, right? So when you think about the mismatch, the biggest reason is you think about a company, and it's like if you're building a business, and also I would say that a lot of these like AI hyperscalers, they kind of throw a rock in this equation because it's like, man, if you can not raise a ton and also get to 200 plus million of ARR, like that's compelling. There's something interesting there. You're scaling really fast, whatever. Like, what does that mean? But if you take a step back from like, who knows, AI, if that revenue is high quality and will stick around or whatever, like that's a different question. But in general, over the last few years, as you've built a business, you sort of start out, you have an idea, it's interesting, you start to get kind of that product market fit, all the classic early stage, budding startup questions. You get product market fit, it starts to work, right? And you get a couple of customers and you start to get revenue and you get to, maybe you're 4 or 5 million of ARR, you're growing 100%. And it's like, this is great. It's a nice business. Like we're getting along, whatever. You start to get a few big customers. And so maybe you've raised a seed round and you've raised a seed round at, call it a 20 or $30 million valuation, right? It's like at that range, like the founders and employees probably still own, call it like, 80-ish% of the company, maybe 60% with like an existing option pool because you think you're going to grow a ton, whatever. So it's like you own 60% of the company. And it's like, all right, your investors invested at 20 or 30. And then let's say you grow and grow and you're doing pretty good. Maybe you're not even burning cash, like you're profitable a little bit. And so it's like you can get to 20, 30 million of revenue. And then like, let's say somebody comes along and they slap a 10x multiple and they acquire you, and that's a $300 million outcome. Like that's great. Like that's a win for everybody. Like the investors got their 10x, you're going to get a ton of money. That's life-changing for everybody, all the employees, whatever, right? Then let's say you have the same business and it's on a trajectory. It's on a similar trajectory. It's like you get to 20 million and you think like, hey, we went from 20 to 200. Like we're going to crush it. We're burning a ton to add a bunch of people. We're building out a bunch of stuff. We're building out this entire new go-to-market function that's going to go chase larger and larger enterprises. We're building out features that can let us close 6-figure contracts. And it's like, great, get to 20 million. And so then you raise a Series A, Series B, whatever, at a, $150, $250 million valuation. It's like, as soon as you sign that doc that says your valuation is 250, the liquidation preference of your investors is significant enough to the point where like anything below that is very difficult to make the math work. And there's a possibility that anything below that, like maybe, because even in the case where your investors had invested at 20 or 30 and you get bought for 100, maybe it's not the return that they wanted, but everybody makes money. If you go out and raise at 150, 250, you do your absolute best, you burn a ton, and you don't get to that 100, 200 plus $1 million of revenue. But you sort of build like a nice business. Like, it's like, let's call it, it's 40, 50 million of revenue. It's grown 20, 30% a year. It's profitable. It's, got good retention, whatever. Like, that's a pretty solid business. Like anybody else, if you owned 100% of that business, you'd be happy because that thing's spitting off cash. But if you get to that point, the odds of you ever being able to clear that 150, $250 million valuation are basically zero. And so if you do sell, like if you could work for 5 years and sell for that price, and basically, potentially, like your investors are going to get their money back. And like, there's a possibility that everybody else makes chump change, right? And so it's like, you could spend years building this, what could be pretty interesting business, but because you picked up the stick of raising a high price round with a big firm that's trying to generate these big things, it's like, number one, okay, you picked up the other end of the stick, which is you need to have a massive outcome. And your investors are never going to be incentivized because either you're clearly not going to drive a big outcome for them once things start to prove out that it's like, hey, this is not exploding. You're going to be a lower priority for them. So they're less likely to help you. And then still you might work for 5. I mean, I have a bunch of founders that I know who are like, it's really difficult for me to like motivate myself to keep doing this because I'm just going to build for 5 years and maybe break even. And maybe I'll make a little bit of money, but I'm not going to make nearly as much money as I thought I would, nor am I going to make as much money as I feel like I should for building a business that's $50 million of revenue.
It's so funny, this like 200, 250, 300 range. I was talking to an M&A lawyer about the same thing last week, Kyle, and this seems to be the gray zone where there's the most consternation or the friction between like a founder having this life-changing exit of being able to walk away with, 20, 30, 40 million, and a VC being like, no, we have to keep going here because you picked up that stick.
Mm-hmm. Like the biggest problem is people not appreciating the implications of the decisions they make, right? When you raise at a certain valuation from a certain firm with a certain check size, whatever, you're picking up a bag of implications of that raise that you have to go either live up to or disappoint people and potentially kind of get screwed in the process. Even if it's not the founders that get screwed, it's potentially the employees that get screwed.
Kyle, I want to dig more into the incentives and the game behind the game here. How do you reconcile the sins of omission versus the sins of commission in venture? Is it worse to back the wrong company or to miss the one that becomes generational like we hit on?
Yeah, I mean, that is a fundamental dynamic in venture, is that it is better for you to be making investments because you already know that, 90% of them are going to go to zero or whatever. And so like maybe, there are some examples. I can't remember there was some story about, it's one of the partners at Greylock, I think, that has like never lost money on a single deal.
Ever?
Yeah,
Wow.
I can't remember the story. You'd have to Google it. And so the question is, and he's had some like really big outcomes.
But is he taking enough swings? Like
So that's the immediate question you ask. I don't know. But it's like, and to some extent, it's like, hey, if he's making money, he's making money, right? So like it's working. But the other question is like, if you are trying to be so protective of your swings that you miss out on the next Google, Facebook, Shopify, OpenAI, whatever, then like the loss is infinite. Like the loss on a sin of commission is 1x. You can't really lose more than 1 times your money, right? Because it's not like sinking hole that's going to suck more and more capital out of you or whatever. I mean, I guess you could if you kept pouring more money.
it's an uncovered short.
Yeah, that's right. It's always going to be 1x your cost basis. The loss is infinite because it's like, there's no telling how much money we could have made on if we had invested in those winners. And generally the thesis is that no investor is good enough that like they're going to get a great hit rate. And so maybe if you're like really, really protective, you can have one of these records like this guy at Greylock who you never lose money. Or maybe you have, maybe you don't have a 90% failure rate, but you have like a 40% failure rate. So it's like you're better than average, whatever. But the thesis is that like you need to be taking those risks to be able to get that upside. I think that this is also this is an element of the bifurcation between capital agglomerators and cottage keepers, is that when you have a multi-billion-dollar fund, you have to deploy it. You can't not. And like when you find opportunities that are like highly capital intensive, all the better, right? That's also, I think, one of the reasons why a couple of these big firms have been able to invest in a lot of more sort of like American dynamism, industrial type stuff, where it's like, hey, these are highly capital intensive businesses, but like there's still great opportunity to be able to invest. And like, yes, they'll take capital and like you can invest a lot of dollars, but they could still be big outcomes, right? You look at Anduril and stuff like that. It's like, yeah, that Anduril has taken in a lot of capital, but they've been very successful with it and stuff. So there's no reason not to do those types of businesses. But when you are a large firm, you feel even more pressure to deploy. When you are a smaller firm, you can be more selective. You still need to take risks. You still need to take shots. You still assume you're going to have a high loss ratio, but you can be very selective about the things that you do. And so I think that the reason that we see a lot of stuff get funded that you're like in an efficient market where our North Star is technological progress, why are we investing in XYZ things? Whether it's like a derivative of a derivative of a derivative of a thing, of like just like it seems like a very kind of low quality idea, or it's like stuff that feels like this doesn't need to exist. Why are we investing that stuff? And it's like, well, like when you have so much capital that's looking for a home, the odds of that capital getting deployed into stuff that maybe is not the optimal place for capital is much more likely.
Like the ghost in the background here, I think, is dilution. I mean, I think about it a lot as an operator because I have to manage the cap table. And I mean, we as employees all have incentives in it. How should operators at these companies that are just gobbling up all this capital think about it? Like, is there almost a disincentive too for people, or like do the funds not care that there's going to be so much dilution?
With all this stuff, like the math is always that in the outlier cases, most of these problems go away. Like usually the places where like raising it too, if you like raise it too high of a valuation, or you take on too much dilution, or you raise too quickly, or you burn too quickly, or whatever, right? All of those things get papered over in the exceptional cases. Like when you're OpenAI, because it's like people see these like eye-watering figures, right? Where it's like, OpenAI is going to burn, OpenAI, Anthropic, like a lot of these businesses are the same way, where they're like, hey, like we're going to burn $15 billion this year. And we're going to make, 15, 20 billion in revenue, but we're also going to burn 15, 20 billion dollars. And so it's like the volume of capital that's consuming to consume all that revenue that you're bringing in and to consume the capital that you've raised. It's like, that's so much capital. But the fact that that business can grow so quickly, can get so disparate, can raise, or can like hire such great people, whatever, all those different things. It's like the fringe cases of like, did we take too much dilution? Did we burn too much? Whatever. It's like those only like come into like, those only matter when you are not the exceptional case. And as venture has become not just power law, like it used to be that it was like 10% drive 90% of the turns or whatever, right? Now it's like 1% drive 90+% of their turns. It's like really, truly like a handful of companies drive the entire asset class. And so it's like, if you're in those 1%, you don't care about burn, you don't care about dilution, you don't care about how much they've raised, because they're going to be these like crazy exceptional businesses. But that's the biggest risk, is that like the vast majority of companies are not going to be in that top 1%. And so you're going to leave a very, not even just a graveyard, but like a battlefield of like wounded and dying companies who have tried to be this 1% and have failed along the way. And then all of those negative things come back to bite them.
Yeah. It sounded like you're saying that the magnitude of outcomes still surprises us. Is it possible that we still underestimate how big some of these outcomes can be?
Well, I mean, the biggest thing is that we have companies that continue to be larger and larger businesses, right? So it's like, you can write off a business like Robinhood and their IPO doesn't go very well and they trade down and stuff like that. But then you turn around a year or two later and it's a $30 billion company. It's like, is that logical? Does that make sense based on where they are or whatever? You look at companies like Robinhood, like Palantir, these companies can get massive. You look at Shopify, right? I think that the biggest problem with venture is that they do have a number of case studies they can point to where they can say, hey, if this can just be even remotely like that, I don't care what we pay, we have to be in it, whatever. This is a great team. This is a great thing. Let's just pour as much capital after that thing as we possibly can, because they have a case study they can point to and they can say, oh, if we could just be kind of like that thing. And that gives them a lot of anchor bias where they're like, that's what I'm solving for, if it can just be that. What there is a shortage of is venture firms that are like willing to do the work to try and drill in and understand like what is the fundamental economic equation that a business is made up of, and can this be a very large business in the long term? And the problem, I think the reason, it's not just that like VCs are stupid, which is often true, but it's also that like when VCs have tried to do that, to say, oh, I think like, this is this, and this is this, and this could be that kind of business, and so this is how we should value it, they're usually wrong. Either they spend too much time thinking about that, and then the company's a zero anyway. So it's like, the economic equation didn't matter after all. Or they spend all that time thinking about it, and they're so dramatically wrong because it's like, hey, like Google, like how big of a business can Google be? Like it's a search, it's an index, right? It's a glorified internet index. Or it's like Facebook. It's like, for college kids, maybe they get to everybody else, but like how big can it be, right? It's like, there's no way that they could see the size of the general population market. There's no way they could see the benefit and addiction of Instagram. There's no way they could see the plugin of things like WhatsApp or with Google with things like YouTube and GCP, whatever. It's like, you can't underwrite that. And so you might as well just not try. Like, it's like, hey, this could be a big thing. Let's roll our dice and see how it works.
Well, I guess to make it more real, if we think about the dynamics of valuation during a hype cycle, what do you think like the recent rounds for Cursor, who decided to go one way, and Windsurf, who decided to step off the track? Tell us about that.
Well, I think that the underlying question in a lot of AI stuff is how defensible these things are in the long term. And I think that the debate has gone back and forth about like, first it was like, like things like GPT wrappers are commoditized and it's really easy. And it's like really the value accrues to the model. And then you have like an open source model that comes out and pops off and you're like, ooh, you know what? Like everybody's competing for these models. Like the model quality you can swap in and out. What really matters is the application value or whatever. And with these like AI coding tools, the like most difficult question to like wrap your head around is this like, because like every business has this like general sense of like, as they grow, they get more market share, they add more product capabilities, they add more revenue streams, whatever. It's like they continue to grow, right? I think about the example of like when CrowdStrike went public. I don't remember these exact numbers, but it was like directionally this. It was like when CrowdStrike went public in whatever, 2018 or something, the consensus revenue estimates for 2024, I think, where it was like 5 years out. Like 5 years out, we like general consensus on the street was that CrowdStrike would be just shy of $1 billion of revenue. It's like, that's about the cadence that like the smartest people who are spending all their time thinking about this business have decided that that's the kind of the slope that it can reach, right? And in 2024, CrowdStrike, I think, had just surpassed $2 billion of revenue. So they were off by $1 billion of revenue. Like it's so wrong. But it's like, so what, it's not the thing that they get wrong is the sort of volume and like slope of the curve, but the direction of the curve is very similar. It's like, we all think that this is a pretty good business. They can add more products, whatever. The problem with this AI stuff is that they may not have those sustainable curves in their business, right? It may not be that it just like, it just keeps, it's like, oh, they like shot up, but it's like, oh, they'll keep going from there. Or like they'll keep shooting up and it'll be really great in this massive business and whatever. Cause it's like, you look at like OpenAI and it's like OpenAI has continued to do that. And Anthropic has done that and whatever. Like these businesses have scaled to very large scale, very, very quickly. And so we're like, hey, every business can do that. The problem is that I don't know, I have yet to see a ton of examples of like really concrete examples of like actual business value creation. And what I mean by that is like everybody talks about like, it's like, okay, whether it's the model or it's the application or whatever you sell into the thing, people experiment with it. And a lot of what this revenue is people saying, oh, the promise of AI is very compelling. But like one of the great quotes that I heard recently is Palmer Luckey talking about this idea of like super artificial intelligence or artificial superintelligence. And like, the biggest obstacle to the adoption of ASI or AGI or whatever is not going to be like, oh, is it this company or is it that company that builds it? It's going to be human inertia. Like if you look at like who are the companies that have made like the most revenue from AI, and it's like right near the top of the list is like Accenture. Like Accenture has made a ton of money helping people figure out what the crap should we do with this thing, and can we actually drive value. And the problem is that like there's not a ton of examples of the rubber hit the road. Like there's a ton of like, we need more compute, we need more, Amazon and Google and Meta and everybody's pouring 80, 90, $100 billion into more data centers, more compute, like all this stuff. The chip companies are popping off because they need more supply. The model companies are raising tons of money to be able to spin out these models, and the models get better and better. There's all these applications that are trying to do all this stuff. And then you have all these people who are trying to figure out like, oh crap, how do I use this effectively? And so we're still in that like massive scale up, massive distribution curve. But what we have yet to see are a ton of like really concrete multi-billion-dollar examples of like this company used AI in this case, trimmed down these costs, saved, hundreds of millions or billions of dollars, or drove billions of dollars in revenue. It's still picks and shovels, like all this stuff of like all the chips and all the data infrastructure and all the models and all the applications. Those are all really picks and shovels for people who are just trying to get a job done. It's the lawyers and the architects and the people, the coders, whatever, who are trying to do stuff. And there's a ton of like, hey, it's driven up productivity among our coder, like among our engineering team and whatever. And like, that's great. The sales team maybe is more efficient or whatever. But like, is it going to drive $1 trillion of productivity gains at the very like rubber hits the road business value creation? And like thus far, the curve of hype is massive. The curve of picks and shovels is pretty sizable. The curve of like business value creation, I have yet to see like a ton of discernible evidence that is like materially following suit behind all this hype and picks and shovels investment.
And behind all the hype, what like always scares me a bit when we get into these cycles, and I hope I'm wrong, and you've written about this, but there has to be a belief that someone else down the road is going to think that this is worth more than you thought it was worth. So you're always doing the back of the envelope math on like, and I don't want to call somebody like a fool, but you can call it like the greater fool theory. Like who is going to think this is bigger? Because when you step into an investment, you have to also think who's going to buy it from you, and then how are they going to think about getting out of it down the road?
Yeah. I mean, so another one of my pieces that was one of my favorite pieces is the institutionalized belief in the greater fool.
That was a great one.
And I think that the reason that it's so important is because it reminds me of this idea. I've never actually, I probably did in the piece and I went and found it. I can't remember if this is a Buffett quote or something, but it's basically the idea is like when we think about an efficient market, it's basically you trying to predict what the market's going to do. What's the stock price going to do? How's the company going to do? Whatever. And the reality is that the way the market is set up is that you're not trying to guess what the market's going to do. You're trying to guess what other people think, like what other people guess the market is going to do. So you're doing this like second layer psychological implication training, right? And the problem with that is that our psychology is all over the place. But you can see this, it's like, look at like, it's like every time you see a meme stock, and meme stock is actually like really difficult to like pin down because every stock can be a meme stock at different times, right? So it's like, I don't know if you saw this, what's her name? Sydney Sweeney or whatever.
The Levi's ad.
Yeah, so she does an American Eagle commercial.
American Eagle, yeah.
And American Eagle stock pops off 18% in one day or whatever, right? And it's like, that's crazy. Or like, it's like the stuff like it can also be negative, right? Where somebody does something and it's like the stock on, what was it? It was like the Budweiser commercial that people hated or whatever, right? Yep. It's like stock plummets and whatever. It's like that shift of like psychology drives markets. Like Kyla Scanlon is probably the person who's written some of the best stuff on this. But a lot of the stuff that she has talked about is this idea that like, narrative and story and vibes have become tangible economic drivers, which did not used to be the case. And the reason it didn't used to be the case is not because we haven't always been stupid and crazy and like excited about stories. It's because we weren't nearly as good at telling the stories and then getting them to everybody and letting everybody react financially to those stories. But now with the internet and social media and everything, it's like we can get those stories out very quickly. We can have them drive an implication very quickly. And everybody has an app on their phone that that can drive hundreds of billions, if not trillions of dollars of money moving around based on that story. That's never happened. And we don't know how to deal with that.
And to bring it back to the Cursor and Windsurf example, like how I interpret it is like Cursor believed that they could raise at, call it 9 billion because there's someone else out there who thinks that they'll be worth 28 or 30 billion. Like that's what the animal spirits are saying. But like with Windsurf, they exit for, call it 2.5. That means like the vibes of the narrative backing that of who the next greater fool will be. There isn't somebody out there right now who thinks it's going to be worth 7.
That's a good question. I mean, so there's this Peter Thiel-ism where he says, fundamentally, any competitive round is an underpriced round.
Ooh.
And if you think about that, it's like, all right, like when Stripe goes out and raises at 90 billion, it's like, okay, if you asked every single person in the world who had money to deploy, if they would invest in Stripe at a higher than $90 billion valuation, the answer is yes. There's probably $100 million at least that would have invested in Stripe at a higher valuation.
It's like a Dutch auction.
And so you think about it literally as like, it's the supply and demand curve. And it's literally an unoptimized amount of supply because there is a more than executed volume of demand. And so it's like, okay, why wouldn't Stripe just go out and maximize? Like, we're just going to raise at the absolute highest
raise
price
at 120
we can.
With fewer investors.
Yeah. And so it's like, why not optimize that equation? And a lot of that stuff is like, it's like the type of business that you're trying to build, the type of investor base that you want to have. Like, there's a bunch of equations, like there's a bunch of factors that go into that, right? The question of like Cursor versus Windsurf, like why did they think this or that? I think there are some fundamental competitive dynamics of like Cursor is seeing their business grow at a pace where their assumption, the underlying assumption in raising versus selling is that we can continue to grow, we can continue to do well, we want to own more of this business over time. All the signs that we're seeing are pointing to this is going great. Let's just keep raising and we keep buying into that story. The reason that a Windsurf would sell is because there is something you would assume, if this is like a logical process that they go through. The reason for that is that they're seeing something in their business that is making them more worried about their ability to continue to maintain. And they say, oh, well, what we need is like, hey, like maybe it's like our gross margins are so low because paying for models and paying for inference is really difficult. That's only going to get worse as we scale. But if we could sell to an OpenAI or to a Google who have both access to the models or access to the compute, then maybe that improves the equation and we can be a better business with them than we are standalone. So that you got to assume that is the math that they're doing. But there's also, for some people, it's like, for some founders, it's like they just got that dog where it's like, I am going to build the most important company of this generation. And like come hell or high water, I'm going to do it, right? And you just keep building it. And I think that there is an element of like Elon Musk sort of aspiration that people have, where it's like his willingness to like drive in, tell a compelling story, raise a ton of money, be super competitive, like push through all these like obstacles and stuff. Like I think that somebody said this. I think it was Bucco Capital.
Oh yeah, Bucco Buyback Capital.
Yeah, Bucco. Yeah. So it's like what he said was like, of all the things that Elon Musk has built, I think the most impressive thing might be the investor base that he's built for Tesla. Because the kinds of stuff he can do at Tesla, the kinds of investments he can make, the kinds of business performance that he can put up, whatever, and not have material changes in the stock, that's an investor base that any publicly traded company CEO would kill to have, like that level of like buy-in and conviction, whatever. And honestly, like I think there is something to be said about, it's almost like inoculation. Like he has inoculated his investor base to be comfortable with massive swings in business performance, because he will balance that with, oh, holy crap, like this robotaxi thing could be crazy and could be huge and has all this data. The humanoid robotics thing could be massive and it could be the largest industry we've ever had and whatever. So they keep getting promised these things that they get excited about, that they're willing to accept these like the volatility in day-to-day business performance. That's incredible. I think that there's something to be said about people like maybe like the Cursor CEO who are like, I am telling myself that story and I am telling my investors that story. Whether or not we all truly believe it, clearly they are making decisions based on that belief.
So we've touched on the psychology behind portfolio construction and also for taking on money. Something that me and you bonded over about 2 years back was like this unbundling of venture capital, because like if you distill it down, VCs, any investor, like they're kind of selling a commodity. They're selling cash. You can get cash from a lot of places. Can you maybe touch on like how VC firms have evolved, and you can even touch on your firm and like the different services that they offer to differentiate?
So I think that there's the piece that I have wanted to write for a long time, and I've just kind of put it off. And candidly, it's like when I first started writing, the two pieces that I wrote, and like the reason I even started writing is because I had these two pieces in my head. but it was the unbundling of venture capital and the productization of venture capital. Like those are the two pieces that I first started out with. And then the productization of venture capital was a little bit of this idea of like, what is the product that we're offering? But the piece that I want to write that is sort of, I guess, like a couple years of hindsight evolution of that philosophy is this idea of like the working title of it, whatever, is building a product-led venture firm. And I think that not enough people, because if you ask like, what do founders hire VCs for? Like if you think about the job that they're offering, there's like a job to be done. Like I, as a founder, have a job to be done. I go out and hire a product that satisfies that job to be done. What's the job to be done that people are hiring venture capital for?
Help me hire people, help me get customers.
Well, so it's a multifaceted question that has a lot of answers. And it's like, how do you prioritize that, right? Like what is the most important thing that you pay for when you hire a venture capitalists? And Mark Andreessen had an AMA a year or two ago where he had a great answer, where he said, I have always thought that the thing that founders are hiring venture like VCs for is borrowed credibility. And that idea is like, okay, if you're like, hey, let's say you were an engineer at Databricks for a couple of years and now you're leaving and you're starting a company. It's like, well, who are you? Like maybe you have a little bit of like brand rub off from Databricks, but like, are you somebody that like customers, hires, vendors, partners, whatever, like fundamentally trust? And it's like, maybe not, probably not like in huge volumes, right? But by going and raising from a venture firm that other people respect. So like the venture capital firm has built this like respect, whether it's through the other companies they're associated with, the other things they've done, whatever, that when somebody sees, oh, well, they're backed by so-and-so, then it's like I as a hire, it's de-risked for me, right? Or I as a partner or I as a customer feel like that's de-risked. So the very first thing the thing that he puts front and center is that you're hiring borrowed credibility. The other argument comes from Vinod Khosla, where he says the vast majority of VCs provide zero value and an unfortunate portion of VCs drive negative value. Like it's actually worse to have them along for the ride than it is if you hadn't had them along for the ride, right? And the way that I think about it is this quote of like, I know that 50% of my marketing budget is wasted. I just don't know which half. It's kind of the same thing as like 90% of VCs are probably neutral to negative value, like value add. But we don't know which one, and you potentially don't know which one. And maybe the answer is not always the same. Maybe it's not always the same 10% of venture firms, because there are venture firms that have grown up over the last few years that you wouldn't have put in that 10% 10 years ago, but that you would now. And so every venture firm is fighting to articulate a product that is good enough that it puts them in that 10% that like can actually drive meaningful value and be this like positive lift and stuff like that. So I think that is like venture firms kind of seek to differentiate themselves. It's not that everybody should have the same product. It's that everybody needs to have a well-articulated product. Like, why should I hire you versus them?
I've always thought it was funny that like Tiger's product is essentially like, we'll leave you alone.
Yeah. I think Tiger's product in 2021 was we'll leave you alone. I think that Tiger as a firm played a thesis and they played it poorly. And I think that Andreessen is playing Tiger's game much smarter. Because I think that like Tiger was like, it was like there's just like the velocity and volume of what they could do, of like the size of the round, the speed at which they would move, the valuation that they could offer, and then just leave you alone. Like that was like, there is a fundamental truth underlying to that. But I think that the fundamental truth was not free capital, like just give you money, leave you alone, go away, cool. I think that the thing that like, I mean, maybe there are some founders who were just like sick, I'll take that. But I think most of them regret it now. Because in a lot of cases too, it's like you take that and it's like, oh, bummer, I wish I had a board to help me figure this stuff out, and I don't. So like there's a bunch of negatives. I think that the underlying first principle that is true though, is that people do want somebody in their corner to throw around their weight that allows them to, whether that's to move fast or to be really loud, whatever it is, the ability to throw your weight around is valuable. Like there is value that people see in that. The danger is that if that weight gets thrown against you, it's very unfortunate and it can be very dangerous. But like in general, when people hire a firm like an Andreessen or a General Catalyst, the thing that they're most excited about, it's either, I think that if you peel back the onion, the first and fundamental layer is actually increasingly, this is what I wrote about in the Unbundling of Venture Capital. I think I maybe leaned too heavily in that piece into like, I think that like individuals are going to become this more powerful thing. There'd be a lot of Elad Gils. There have not been nearly as many Elad Gils as I thought there would be. But I do think that the unbundling of venture capital has a principle of truth in that people care way more about the individual partner, right? So it's not just like I can take Andreessen's money and that's good or bad. It's that if I take Andreessen's money from so-and-so, that's good. If I take it from so-and-so, that's not as good. Like there is relative value in the individual partners. That's true fundamentally. So there's first that personal relationship. But then when you're deciding like, okay, I like the person at this firm and this firm and this firm, but I could take it from this firm and it would be like an Andreessen or General Catalyst style like weight. Or I could take it from this firm and it's going to be more like a benchmark, or even like, I mean, Excel is not a small firm, but like Excel acts a lot more like benchmark than they act like Andreessen. And so like you're picking up a style and you're getting something from that style, and you're not going to get loudness from benchmark. If you raise from benchmark, you're not going to get the same loudness that you're going to get from Andreessen. So it's just up to you to decide what you think is most advantageous for your business.
But there is like a Kyle brand and a contrary brand that you get when someone takes money from you, and they're similar and they rhyme, but they're not identical.
I mean, that's the like unbundling. I think it's like more of a loose unbundling than I thought it would be. I thought it would be more of like so-and-so would feel so good about their brand at Andreessen or at Lightspeed or whatever that they would leave and start their own firm. You've seen that a couple of times. Like you've seen a handful of people leave and start new firms. And you're definitely like, if you go back and look at that, it's like, I think that it's just that it took the shape more of like how other venture firms have gotten built. It's like very similar. Even though there are like newer firms spinning out of established firms, they're not spinning out to be Elad Gil's. They're spinning out to be kind of a traditional venture firm that like is less well known. It's younger, it's scrappier, whatever. And I've seen that a bunch. Like it's like I look at like when I was at Index, there are like 4 people who have left Index that were there with me who have all started their own firms. You know, folks like Chemistry is a firm that got started by Mark Goldberg, who I worked with at Index, right? It's like that style is like much more common. There's very few people who go and become Elad Gil's or whatever, right? But I think that like that unbundling shows that like relationship. But I think that also this is another going back to the like founders don't do a great job of like really thinking deeply about the implications of fundraising. One of the things that I think people also don't think enough about is like raising from Andreessen can be good or bad depending on who's the person who drives that investment, right? Because there are some people who it's like, hey, you know, that's probably not the best partner. Like and a lot of times we have these conversations with folks. We're like, hey, I'm talking to so-and-so at big firm XYZ. And we're like, hey, we've heard some not great things about that particular partner. But then they might say, hey, I'm talking to so-and-so at big firm XYZ. We'll say, oh, they're great. Like they're super sharp. They're awesome. And they can go to bat for you internally at such a big firm. Like that's important. But if you're getting like either like a very junior person or like a person that has kind of a not great reputation or whatever, there is a fundamental difference. But you could look at Andreessen and say, this is a good partner, this is a bad partner, this is a, lukewarm partner, whatever. But the reality is like, okay, that's a question of like, how do I like this person? What do I think of them? How do they reference? But then when you raise money from any of those people, from Andreessen or from General Catalyst or whatever, there is still implications inherent in raising from that firm, regardless of the partner, that would not be true raising from a different type of firm.
So you get the power dynamic. Can they throw around their weight? Can they get you in the room with the right people? Can they knock down barriers from like maybe a political or governance standpoint for you? Then you have the element of like the partner themselves. How do you get along with them? I do think there's this other box too, which you've touched on before. Like I'll give an example. Like one of the benefits of taking money from Insight, say you're a cybersecurity company, they have 450 portfolio companies that you can hawk your wares into or something like that. What are some of the other benefits that founders or CFOs when they're raising money should like stack rank in terms of like what does taking money from this firm get me?
I think that every firm is different and every company is different. And I think that like when you are a first-time founder who's never hired anybody in your life, the ability to be able to tap into like a talent network, to be able to like get a good benchmark for what good looks like and stuff like that, to get some support and help as you try and grow a team, that can be valuable. If you're like a third-time founder and you're going to hire a lot of the people that have come with you to your previous companies, that's way less valuable, right? So I think that like there's not enough conversation around the variability of different founders working in different spaces will benefit from different things. Another good example is like there are a number of companies that are, they're selling into government increasingly, right? As we see more like defense, aerospace, industrial type companies, they have a lot more government work than the traditional SaaS company might have, right? And so there are some firms that have gotten built, I would say like either it's because they have a lot of experience investing in those categories, or it's because they have very deliberately built their experience to cater to those people. So a good example of like they've just kind of gleaned it over the years of building these companies is like Founders Fund is a great firm to raise from if you're selling into defense and government. But then you also have folks like Construct Capital in DC. And if I remember correctly, it's one of the founders of the firm was like Uber's general counsel for years and years. And so like she's navigated a bunch of very complex, government regulation type of questions. And so Construct is a great firm if you want to have access to that type of expertise and stuff. So different people get built up around different things. And so it just depends on what you as a founder feel like is most important and most valuable to you. That's also one of the benefits of like you raise multiple rounds is like you're kind of putting together an investor base where it's like, I get this from so-and-so and I need that early on, but then over time, I'm going to need more of this. And then later in my later rounds, I'm going to need folks that can just like, I'm going to need to raise a lot of capital. That's why you see a lot of folks who will raise from firms like a Wellington or a T. Rowe Price or whatever. And it's like, because those are like massive asset managers who can like write pretty sizable checks. And if you're going to raise a lot of capital, like those are good folks to have on your cap table because they can throw capital around probably even quicker than like an Andreessen could.
And they can double down if you IPO.
Yeah, that's right.
Maybe gearing towards a close here. So you had made a spicy point that I wanted to hit on real quick, that if we just left Sam Bankman-Fried alone, a few of those deals might have actually paid off that whole FTX crater that was left. What is there like a truth buried somewhere in here? I'm like trying to square how this works.
My undergraduate degree is in accounting, and I remember learning about the fraud triangle in accounting.
Yes.
And this idea about like it's effectively this sort of like means, motive, and opportunity and whatever, and like similar things. Like if what's the motive if you have a financial opportunity, if there's not controls in place to make sure that you can't commit fraud, that kind of stuff. The obstacle is like everybody who's committing fraud thinks that they can get away with it, right? And thinks that they can cover it up, right? If you're like, hey, I need this money, I'm going to take it, but like I'll make up for it, by selling more next month or whatever. And you try and pay that loss over, and the loss just gets bigger and bigger and bigger. And then that's where you get, massive, Ponzi schemes or huge Enron cover-ups or whatever. Like that logic is always true. And so it's very dangerous when you start justifying what is either immoral or illegal behavior up front with the potential for future coverage down the road. I think the takeaway for me is not that necessarily, I guess like in this specific instance, what is painful is that because they brought in the Enron guy to FTX, right? And in order to try and cover some of the hole, they sold positions. And if I remember correctly, I don't remember, I've never looked really deeply into all the explicit details, but I think if I'm not wrong, he had both a seed investment in Anthropic and maybe a seed investment in like Cursor.
Yeah.
And they sold both of those years ago. And so it's like, if you had held those, you wouldn't have, and so it's like, that's painful. But I think that the takeaway for me is not, dude, you should have just let the guy cook and it would have been fine. Because I think like he shouldn't have been doing things that were, that were illegal and like trying to cover up things and rob Peter to pay Paul and doing all this stuff. It's like the laxness of financial institutions, because that's what FTX was, right? It is a financial institution, and you're letting people that are, playing League of Legends with one hand and taking money out of their users' bank accounts with the other hand and not telling them. It's like, that's not great. That's not a great system to have, right? But the obstacle is like when you do that stuff, when you decide to act immorally or to tell stories out of turn or whatever, you lose the opportunity to compound. I think that's the takeaway for me, is that you have to, because it's basically, and this is a Buffett Mungerism, where it's like this idea of like the market can stay, what's the saying? The market can stay irrational longer than you can stay liquid.
Yeah.
And it's like, so what you have to do, it's like you will lose and you will win. The only thing that you can't do is get knocked out of the game. Because as soon as you get knocked out of the game, compounding ceases to work.
That's what happened.
And that's what he did. SBF knocked himself out of the game. He flew too close to the sun. He knocked himself out of the game. If he had not flown so close to the sun and he'd allowed himself to stay in the game, even if like FTX would have had to see like massive drawdowns and big problems and issues and whatever, but by doing things that were like impossible to fix, he took himself out of the game, and then compounding ceases. The best businesses are the one. I mean, I think you look at like a lot of like, we're working on a piece for Contra Research right now looking at a bunch of these like neobanks and stuff, right? And it's like when we went into kind of the sort of post crypto winter, fintech, whatever, it's like there was a lot of like fintechs that kind of just got left for dead, right? And it's like there are actually a number of pretty exceptional neobanks that have gotten built over this era of the sort of, fintech winter that have not gotten a lot of attention. But those are good enough businesses that they have been able to compound and to grow and to become the sort of default in certain countries and whatever. Like those are not bad businesses. They just needed time to compound. And sometimes they have to compound through winters. It's the same thing like, I think the Coinbase guys talk about how when I think it was either in 2022 or I think it was maybe the 2017 winter, the crypto winter, their reaction to that was like, thank goodness, like we need this washout because there's so much hype and hucksterism that we need to wash it out. And also they could have relief because they knew that they had built their business in a way that it could weather that storm and it would allow Coinbase to continue to compound and stuff like that. And you see that too, like when they went public and then, whatever, like the stock performance, it's like, that's, I think if I remember correctly, the numbers, like that's a 10 bagger in the public markets. Like I think they were at 9, like their low was 9 billion and they're now north of 100 billion. Like, it's like, that is them building a business that can withstand volatility in a way that like the majority of businesses in crypto have not. A lot of AI companies are not building themselves to withstand volatility either. Like if let's say the AI, tide turned right now and everybody was like, all right, just kidding. Like this is not proving out in the long run. We're going to turn off a lot of the, infrastructure investments that we're making. There's not going to be more data centers. There's not going to be enough compute. You're going to have to compete. Your margins are going to go down because inference is going to get more expensive because these companies are not investing in stuff, whatever. It's like there is a plethora of AI companies that would get wiped out tomorrow. If their gross margins dropped by 20%, they die. And those are companies that are not building themselves the right way to give themselves the advantage of allowing themselves to compound through volatility.
This has been a blast. Maybe just to put a bow and a ribbon on things, if we fast forward 20 years, what's one thing about today's venture landscape that you think we'll either laugh about or wish we paid more attention to?
Unfortunately, I think that the thing that is likely to become more supercharged, not less, is I think that people assume that we are in a period of heightened hype. And the reason that I don't believe that is because I've been through this now 3 times, just in my, it's not like I'm a weathered, gray-haired, veteran. It's like I've been doing this for 11 years.
3 cycles.
It's like you count like 2017, 2021, 2023, whatever, 2024. It's like those cycles. It's like what I have seen that has stayed consistent is that the value of a narrative is only increasing. It has never gone down. Like it's never once gone down. Sometimes the story gets harder to tell when the stock plummets or the token price plummets or customers leave or whatever. Like those things make the story harder to tell. But the value of a good story is going up. And I think that what we are dramatically underappreciating is that we are fundamentally a society that is built around storytelling and like shared narratives. And we're assuming that like reality is reality. And like these fuzzy stories that people are telling each other, that's fugazi, whatever. But the reality is that like, I always say this about my writing, and I'll end with this because I think this is the most important takeaway for me, is I used to think that reality would eventually win out over narrative every time. It's the Buffett, eventually the market, it's a voting machine, but eventually becomes a weighing machine. The problem is that we assume that narrative has no tangible weight, but it does. Like when it gets to that weighing machine, you will weigh and measure whether or not you had a good story, but that story is like a tangible part of weighing the company, the narrative, whatever. And so I think that increasingly the hype and the narrative and the storytelling and the what feels like a distance from reality, I think that is only going to become a bigger part of the story, not like a blip in time, right now where we all lost our minds.
Can't think of a better way to end it. Kyle, thanks so much for being generous with your time today. This was really fun.
Yeah, super fun to jam, man. Thanks for having me.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.